Hi, everyone. Welcome. We'll just wait a few minutes for everyone to get into the room before we get started. Welcome, welcome. Welcome, everybody. We're just waiting a minute or so for everyone to get here. Okay, I think we can go ahead and get started. Hello, everyone. Welcome to our next webinar in the Back to Basics series, Investments. We're happy to have you here with us today. Before I introduce our speaker, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. LSL is using a new CPE system, so please note that the evaluation email will be coming from LC Vista. Please allow up to 1 week to receive this email. If you're having trouble seeing the polls, try minimizing the Zoom screen as sometimes the poll question box pops up behind it. You may need to click and drag the Zoom screen around a bit to find it. If you're using multiple screens, check each one as it may pop up on another screen. If that doesn't work, you may need to disable your pop-up blocker. Now I'd like to introduce our presenter. Heather Flores is a manager in LSL's Assurance and Advisory Department, bringing over 16 years of experience across commercial, nonprofit, and government sectors. For the past 6 years, she has focused exclusively on government audits, helping cities, districts, and public agencies navigate their financial reporting and compliance requirements with confidence. With experience on both sides of the audit, public accounting, and private industry, Heather offers a well-rounded perspective and a collaborative mindset that clients truly value. Also, behind the scenes is Ryan Domino, partner in LSL's Assurance and Advisory Department. He'll be behind the scenes answering your questions in the Q&A box, so feel free to put your questions there throughout the presentation. Okay, Heather, take it away.
Thank you, Rachel. Okay, so as Rachel mentioned, we'll be going through investments today. And the objectives for today, we'll be covering best practices for investments. We will also discuss typical items that are related to reconciling investment balances to general ledger. We'll also discuss year-end closing entries, such as GASB 31 for unrealized gains and losses, and interest allocation for interest income among pooled investment accounts. We'll also go over some reporting disclosures for investments that you'll typically see on financial statements, and then also just discuss common errors that are related to pooled cash and fair value adjustments. So we're going to have our first polling question. So which investment constitutes the largest portion of your entity's funds? Is it local agency investment funds? Is it B, California Asset Management Program, C, Equity Securities Program, or Equity Securities, or D, Mutual Funds? So as you're going through that, just take your time and just select which one you think the largest portion of your entity's funds is invested in, and we'll come back to those results in a little bit. Okay, so going through investments. So let's discuss some best practices. So first, the GFOA recommends that a government establishes and have its governing board adopt an investment policy. An investment policy describes the parameters for investing government funds and identifies the investment objectives, preferences, or tolerance for risk, constraints on the investment portfolio, and how the investment program will be managed and monitored. So in other words, the document itself serves as communication tool for staff at the government, for elected officials, for the public, rating agencies, bondholders, and any other stakeholders on investment guidelines and priorities. An investment policy enhances the quality of decision making and demonstrates a commitment on the fiduciary care of public funds, ensuring safety and managing risk of public funds, and that the government can meet its liquidity requirements. So again, GFOA recommends that all governments establish and have its governing board adopt an investment policy, and the investment policy should be reviewed and updated at least annually, and should adhere to state, local, and other government policies. And typically, auditors will ask for this policy, and then we'll inquire if the board has reviewed and approved it. Another best practice is collateralizing public deposits. So depending on state or federal law, public unit deposits may be secured by collateral or assets of a bank or financial institution. So the FDIC insurance will cover up to $250,000 for each entity. Deposits above this FDIC limit must be collateralized to ensure the safety of public funds. So collateralizing of public deposits through pledging of appropriate securities or other investments, like for example, a surety bond or letters of credits by depositories, is an important safeguard for such deposits. So the amount of pledged collateral is determined by government's entities' deposit level and the policy or legally required collateral margin. Another best practice is diversifying the investment portfolio. So again, the purpose of this course is just to kind of go over investments. It's not like an advising on investing or what investments that your government should be investing in. It's more just like going through, some good and best practices of what to keep in mind. So as a government decides, what investments to use, they have this fiduciary responsibility to protect the public funds and to prudently manage their investments in order to achieve the investment objectives of safety and liquidity and return. So generally, greater risk in a portfolio increases the opportunity for higher returns. But however, that greater the risk will also could increase the volatility of those returns. So the effective management of risk in a portfolio is critical for achieving an investment's objectives, which ties back to the investment policy. A useful strategy for managing risk in a portfolio is through diversification. To this end, a government should establish, a target risk profile. Its risk profile in turn helps it to determine appropriate levels of diversification. Diversification investments in portfolio is based on the different types of risks, primarily interest rate or market risk, also liquidity risk and credit risk. Diversification is achieved by investing in a variety of securities with dissimilar risk characteristics that respond differently to the change in the market. Areas where diversification can be achieved include the maturity distribution in a portfolio, a sector allocation, issuer allocation, and the structures of securities. Fourth best practice is presenting investment reports to a governing body. Typically, that should be done quarterly. A usual also audit request is for us to ask for the quarterly investment reports and verify that they have been reviewed and approved by the board. and that, management agrees that the amounts presented to the bank or brokerage firm or other financial institution statements. And then lastly, would be the safekeeping and third-party custodian services. So there's generally two types of safekeeping services that a government will encounter. One is the basic safekeeping provider, and another is custodial safekeeping provider. Under the basic safekeeping, these fees are nominal, and the service is provided at no direct cost. Investment assets are held in the safekeeping firm's name for the benefit of the government, and services provided are limited and may affect the government's ability to access its assets timely. And most operate on actual receipt of funds basis, while the custodial safekeeping provider has a fiduciary responsibility to its client. And typically, though it's charged, there is a fee associated with it. The elements of custodial safekeeping includes investment assets that are protected from the claims of creditors, as the assets are considered legally separate from the bank or financial institution. Also, the ability to use any broker or dealer for trades that settle into accounts. Excuse me. So the GFOA recommends that governments use an independent third party custodial service for safekeeping of investments, just given the additional, the additional services that come along with that. But again, governments need to weigh like the risk versus costs of those services and understand exactly how the failure of a safekeeping provider would impact the government's ability to access its investments assets. Okay, so going through the polling question results. So it definitely looks like, show these over there, that LAIF had the most, and then CAMP, then equity securities, then CAMP and mutual funds are about the same. So as I expected, probably I would expect the majority to be LAIF. Okay, so now we'll discuss about reconciling investments to general ledger. So typically GASB 31 is what drives making sure that investments are being recorded correctly on the accounting and financial records. So GASB 31 establishes accounting and financial reporting standards for all investments held by governmental external investment pools. For most other governmental entities, it establishes fair value standards for investments in participating interest earning investment contracts, external investment pools, open-end mutual funds, debt securities, and equity securities. Participating investment contracts are investments whose value is affected by market changes, and they participate because they are negotiable or transferable, or the redemption value considers market rate. The fair value of equity securities, option contracts, stock warrants, and stock rights is readily determinable if sales price or bid and ask quotations are currently available on a securities stock exchange or in the over-counter market, provided those prices or quotations are publicly reported by the National Quotation Bureau. Now, GASB 31 typically does not apply to investments held by governmental external investment pools, defined benefit pension plans, and deferred compensation plans. Typically, GASB statements 2 and 25 will contain standards for those valuation and reporting of those investments, and should be followed. Just to recap, a governmental external investment pool is sponsored by a state or local government, sometimes known as a local government investment pools, and it provides investment services to other legally separate government entities such as counties, cities, and school districts, and it exempt from registering the SEC due to governmental exemption. So then just to go through like some typical types of investments: security deposits, local agency investment fund administered by the state Treasurer's Office, which is an example of an external investment pool that would be subject to GASB 31. And then CAMP, which is a California Joint Powers Authority to provide California public agencies with professional investment services. And just to highlight, the CAMP cash reserve portfolio usually would follow GASB 79, just based on like liquidity, maturity, quality, and diversification requirements. And that would be valued at amortization cost. So just to be sure to review the maturity and qualifications to be valued at the amortization cost. So now kind of leading into that, let's just go through typically investment valuations and which ones, should be amortization costs and then which ones would be fair value or what have you. So first, money market investments are short term and they're highly liquid debt instruments. Excuse me. And those include like commercial paper, bankers acceptance, and U.S. Treasury and agency obligations. Those typically are going to have a maturity date of purchase of 1 year or less, and they provide fair value of those investments. Not as long as those fair value of those investments are not significantly impacted by the impairment of the credit standing of the issuer or other factors, then those are allowed to be reported at amortization costs. Fair value for investments in open-end mutual funds should be determined by the fund's current share price, and investment positions in a 2A 7-like pools should be determined by the pool's share price. And then for investments, that have longer than a year or are equity securities or things like that, those will just be valued based on market to market. So, question to maybe consider and to ask is how often should investments be reported at fair value? And, at a bare minimum, investments should be marked to market as of the date of the financial position. But we'll also discuss that further along in the course. So here's an example of a GASB 31 journal entry. So let's just go through the example really quickly. So a local government invests $100,000 in an external investment pool on January 15th, receiving 100,000 shares or units in the pool. The pool is not a 2A 7-like pool and does not have a legally binding guarantee for its share price. However, the pool seeks to maintain a stable dollar net asset value as a matter of day-to-day operations. Participants enter and exit the pool using the dollar net asset value. On June 30th, which is the end of the local government's fiscal year, the pool sponsor reports that the pool participants should fair value their pool position at $1.05 per share. On October 15th, the local government withdraws its investments in the pool using the dollar net asset value. So how does the participant report the investment in the pool at June 30th? So let's go back. So on January 15th, the investment should be valued at $100,000, which is the fair value on the date that it's acquired. At June 30th, then that investment should be valued at $105,000 in the financial statements based on that increase in net asset value per share, which was increased to $1.05, which translates to $5,000 increase, and that should be included on a participant statement of operations and investment income as an increase in the fair value of investments. Then on October 15th, when the investment is withdrawn, investments are reduced by $105,000, and the change in the fair value of investments is then realized and charged as $5,000 because the fair value change is reversed. So going from that example we just went over, here are the journal entries that would be used. So January 15th, there would be a debit to investments of $100,000 and a credit to cash of $100,000 to record the initial investment and the external investment pool. Then on June 30th, to record the change in fair value of investments, there would be a debit to investments of $5,000 and a credit to change in fair value of investments of $5,000. Then on October 15th, when you're recording the withdrawal from the external investment pool, you will then debit cash of $100,000. You'll debit the change in fair value of investments of $5,000 and credit investments of $105,000. So another item to consider, again, when you're reconciling investments to the general ledger is the interest allocation. Government reports the entire position of its internal investment pool as cash and cash equivalents in the general funds, with an amount due to other funds for those other funds positions in the pool. Each fund with a position in the internal investment pool should report its position as equity and cash management pool, cash and cash equivalents, or investments with corresponding interfunds receivables and payables for the other fund's equity positions. So typically, each fund would be allocated interest based on a weighted average on the investment balance in the fund multiplied by the monthly interest rate. It is important to note that the interest should not be allocated to negative investment balance, and government should report negative investment income as negative revenue. And we'll go through that again when we discuss common errors at the end of the course, but I just wanted to bring that up also here. And then also just to remember for any business type proprietary funds, if they distinguish between operating and non-operating income, the change in the fair value of investments should be reported in the same manner as other investment income is reported, which typically would probably be non-operating revenue. Okay, so now our next question. Polling question number 2. How often do you reconcile investments? Daily, monthly, yearly, or I don't touch any reconciliations? And as you're answering that, I'm going to grab a quick sip of water. Okay. So now we'll discuss financial statement disclosures. The governmental entities should make the following disclosures in the notes to financial statements. In the methods and significant assumptions, usually that's typically like in the footnote number 1 or number 2, you'll want to define and make sure that you're defining the methods and the significant assumptions used to estimate the fair value of investments if that fair value is based on other than quoted market prices. Also, you want to include the policy for determining which investment, if any, are reported at amortized cost. And and again, if an entity cannot obtain information from a pool sponsor to allow it to determine the fair value of its investment pool, the method used and significant assumptions made in determining that fair value and the reasons for having to have made such an estimate should also be disclosed. And then for any investment in external investment pools that are not as SEC registered, a brief description of any regulatory oversight for the pool and whether the fair value of the position of the pool is the same as the value of the pool shares will need to be disclosed in the footnotes. Some other items to consider that should be disclosed in the footnotes. It's not as common, but if there's any involuntary participation, an external investment pool should be disclosed, and then any income from investments associated with one fund that is assigned to another fund should be disclosed as well. And then we're going to go through some examples of these other items that you'll need to disclose in the footnotes. Interest rate risk, that is the potential for the value of financial assets or liabilities to change due to shift in market interest rates. Custodial credit risk is the risk that in the event of a failure of depository institution to the government will not be able to recover deposits or will not be able to recover collateral securities that are in possession of an outside party. Concentration of credit risk. That is the risk that due to lack of diversity in government's investments, such as holding more than 5% in a single issuer. Credit risk focuses on the potential financial losses due to the failure of counterparty to fulfill its obligation, and is usually defined by the Moody's ratings or Standards and Poor's ratings and the notes to the financial statements. And then finally, the fair value measurement and application, which goes over the fair value hierarchy of investments. So before we go through those examples, it looks like that the polling question number 2, that most reconciling of investments are done monthly, which I think that is a really good, really good best practice to do it monthly. Daily, I think, would be kind of hard, given if you have a lot of volume, and it's better to make sure that you're looking at it on a monthly basis. Okay, so here are some examples for the footnote disclosure from one of the clients that I've worked on. And so let's just go read through them just to kind of have and just to kind of see how that would apply to your entity. So for this one, the interest rate risk, basically you just want to define again what the interest rate risk is. And then also you want to highlight that how the weighted average maturity method is used in managing the interest rate. And again, you also want to make sure that you note the weighted average to maturity of the pool, the days that the weighted average maturity is. Then for the custodial credit risk, here's an example where you just want to highlight, again, if there's an event of a failure of a depository institution, that the county or government would not be able to recover the deposits. And you'll just want to highlight the deposits and investments held by public institutions, and if there was any uncollateralized deposits, and just making sure that all ties back. Then for concentration of credit risk, if there is any external investment or in mutual fund or in a pool that represents more than 5% of the total investments, you'll want to highlight that here. So in this example, the Federal Home Loan and Bank had represented more than 5% of the investments, and that was disclosed too. Then for credit risk, again, you'll just want to identify items that have the credit risk, and just want to notate the ratings and given, and sometimes you can either use that as a chart, or you can like highlight here in a paragraph. And just like this, again, here's a chart showing the different investments and credit ratings, and showing also the weighted average maturity dates and the amounts for each of those investment types. And then here's the disclosure for the fair value measurements, which I think sometimes be sometimes one of the more difficult for the disclosures for investments. And you want to make sure, based on the investment, that they're categorized in the correct level 1, level 2, and level 3. Level 1 is going to be investments reflected quoted market prices and active market spread and pool assets. Level 2 is going to be investments that reflect prices that are based on observable inputs, either directly or indirectly, of similar assets, or which may include inputs in markets that are not considerably active. Level 3 investments reflect prices based upon unobservable inputs. So here is an example of the disclosure of the table that would be in the financial footnotes. And as you can see, based on the, if you're able to see inputs with quoted prices, it will be level 1. Level 2, it's going to be significant other observable inputs, and level 3, they're going to be unobservable inputs. And just to kind of reiterate, typically, CAP and LAIF will not be categorized on the fair value hierarchy. And then here's just another example, just kind of a different client and how that information is still presented. So there's a lot of different ways that it can be presented, but just wanting to make sure, again, just that the investments are being put in correctly by the different levels of the fair value levels. Okay, so polling question number 3. Which area of financial disclosure poses the most significant risk or challenge for your organization? Is it interest rate risk, credit risk, fair value measurement and application, or concentration of credit risk? So now we'll discuss how auditors will audit your investments. So the audit steps to audit your investments. So let's just discuss at it like as a high level what as auditors will be reviewing when we review your investments and your reconciliations. The first thing any auditor will ask for is a list of all your organization's bank accounts, including the last bank statement for the fiscal year being audited, or the investment statements that you have, if it's with a brokerage firm. The main reason for this is so that as an auditor, we can ensure nothing is missed and that all the GL numbers subject our audit to agree to your records. This also helps us as auditors to put together a list of accounts that we're going to want to confirm with the bank. And then LAIF, we are able to confirm that differently, but still, if there's any investment outside of that, we'll get that information from you. And then as part of step 1 and going to step 2, as an auditor, we'll need to review the GASB 31 for market value entry that you posted so that we can agree any accounts subject to fair value, market value to the GL. So this is going to be your investment accounts. And then as part of the agreeing process, we'll make sure that it also agrees to the footnotes that you prepared to ensure what's reporting on the financial statements are correct. And then as previously mentioned, we will confirm investment balances either directly with the financial institution or possibly through confirmation.com. Or sending confirmations directly to the financial institution via email or mail. And then finally, we'll review your investment reconciliation, including reconciling items, timing, and documentation. And typically, there's not going to be as typically many reconciling items as there is for cash for investments, but if there are any, we would be reviewing that information as well. So for here's an example of an auditor's work paper that we might look like when we're reconciling the investments, and then also we have cash included here as well. And typically we look at both similarly, but investments obviously is the main key with investments is the fair value. So you'll see here it's broken out into 3 different types. It's the cash investments and restricted investments. You'll notice a total for unrestricted cash and investments and restricted cash and investments amounts that will agree with the 2 lines on the financial statements. So here at the bottom, where it says the total cash and investments per fund, that's gonna be where we're referencing to the GL that was given to us by your organization. And then so overall, you can kind of, and we'll go through just for LAIF on the next slide, how we're calculating that fair value. But overall, you're going to see that in this example, the difference came down to a $360 variance. Typically with cash investments, we like that number to be as close to zero as possible, just to ensure that's nothing missed. But in this example, it's related to a small reconciling difference on the fair market value. So I just want to highlight a couple numbers before we go to the next slide, but it'll also be over there. The LAIF, bank balance before fair value is at 24,932,372, and then we'll go and look at the next slide to see the adjustment for that. So here, again, the top part is where we're confirming LAIF, and this confirmation we pulled from the LAIF website. And you're going to notice that the balance agrees of 24,932,000 to the confirmation here before the fair market value. LAIF is subject to manual calculation based on a published fair market value that we'll see on the next slide. So we obtain the fair value adjustment factor for LAIF from this report, and at June 30th, 2023, it was 0.984828499. So just by taking the balance at June 30th, 2023 in this case and multiplying it by the factor, we get the fair value adjustment of 24,544,111. And again, we would then compare this to the GL. And in this example, the difference is 161,000, which is immaterial. So then just to go over some common mistakes and questions that can happen when you're going through investments. One, again, is the interest allocation is off. For an organization out there, when you're pulling your cash, this can be an issue. Usually it's a system issue because if you want to allocate cash or interest to every fund, including your GASB 34 tracking funds or other funds that don't have cash, excuse me. Another common mistake is accounts with negative cash that can get allocated at interest revenue. And these things are things that an auditor will look at to make sure your entry makes sense. And again, you want to make sure that you're doing the fair market value entry and that it always needs to be reported. And kind of like how we talked about earlier, the simple answer is to be recording that fair market value at a minimum monthly or for sure at your financial institution date, year-end date. But the reality maybe, but an auditor will make you report the fair market value if the difference is material. But I would just always recommend just to go ahead and make that adjustment, just because then as you're presenting reports to the board members, they're seeing a current to date outlook of what your investment balances and cash balances look at that point in time. And then so kind of discuss like the first two. Another thing to consider that can be a common mistake is impairment valuation reported, and that would be using the cost-based measures. Again, if the underlying investment creditor or if the underlying financial institution is having, financial issues that could possibly lead to impairment valuation for your investment. The chances, are not as likely, but if that were to happen, you want to then for sure be using the cost-based measure, which would be going back to the investment that you purchased at cost and not doing that fair value adjustment. And then something else to consider are the external circumstances that that can negatively affect markets. So, like back in 2020, when COVID occurred, that had a significant impact on the stock market, and then because of that, investments valuations decreased, and there was also a need for more disclosures in the subsequent event footnotes, and also in the following years, just given that change and that impact on the stock market and how it impacted fair value. So let's go to the next slide. And that'll be polling question number 4. And then, do you feel more confident in what you need to prepare for your auditors? Absolutely, I feel the same. No, I'm still confused. Now we'll go through some questions. Again, I know that Brian's been answering questions in the background. But let me just pull up those Q&A to see if there's any that we can discuss.
Hey Heather, yeah, there's actually one question in the Q&A box still open, and then we had a few come in the regular chat as well. So I'm not sure if you wanted to take a look at the Q&A box first, and then I can tell you about the other questions.
Yeah, let me take a look through that real quickly. Okay, so one question regarding, let's go through that. Concentration of credit risk. Should investments in affiliates and subsidiaries of parent corporations be aggregated for determining the concentration of credit risk of an issuer? Affiliates and the answer should probably be like affiliates and subsidiaries of parent corporations may be engaged in similar activities and may have similar economic characteristics that would cause their ability to meet contractual obligations to be similarly affected by changes in economic or other conditions. So in these cases, the government should consider the credit risk of the parent company, its affiliates, and its subsidiaries in determining whether government holds a concentration of credit risk. So hopefully that answers that question. Let me know if you have any others.
If I could just jump in,
Yeah,
Heather,
go
I think that was actually a quote from the authoritative guidance, and the question is subsequent, is how I'm reading that. So I think the question was, how do we aggregate by issuer? What is the criteria to use? Is it QSIP or some other, some other criteria that they would use to aggregate?
I think probably, you can correct me if I'm wrong. I mean, I would think you would aggregate. I think it would just be by the issuer. What do you think, Brian?
Yeah, that's how we normally do it. It's not always by QSIP. It's normally by, if it's Fannie Mae or Freddie Mac, you would incorporate all within that, regardless of if it's the same QSIP or not. Okay, so it looks like you have another question just popped into the Q&A box as well. So I figure we can get to that question before I'll bring up the ones that were in the other chat.
Sure. So question is, what do you consider immaterial in terms of percentage for having to book the fair market value? Yeah, I think that's a good question. And typically as auditors, we do our own calculation for materiality, and we like can't disclose that number. But if it were to become material as we're going through the audit, we would definitely have that conversation with the client and let them know that this is material and it should be booked. There's different ways out there that you can Google and learn how to calculate materiality and determine, I think, at your government what you feel comfortable with in terms of like percentage or dollar amounts. But I think that may be something that internally you would need to consider based on your size and the size of the investment, and then just your overall fund balance.
Awesome. So yeah, some of the questions that popped up, it looks like there's quite a few related to fair market value and how to determine it. So the first question that's in here is related to booking fair market value and what documents should be used. The situation that's in here is that they have obviously the investment account statements, and then there is the investment advisor that the city has hired. So they have typically a little bit of a discrepancy between what the trustee says and what the investment advisor values them at, and they would like to know what is the best way, which statement to use, essentially.
Yeah, that's a good question. I would defer to like if the statement is pulling valuations from like a quoted market. If you're able to get like a third party, like if it's through finding that fair value, say if it's an equity security in that investment, and then getting that valuation, and if which one is more accurate, or if it's like a level 3 where that's highly unobservable. In that case, it may be kind of hard to know. I would maybe possibly use like the investment statements. And because sometimes the investment advisors reports are a little bit different. Again, I would just go back to seeing which report is using an appropriate valuation for that. Again, like if it's the for lack of a better word, like yahoo.com, where you can go through the finance, you can look up the security symbol, and you can see the valuation. And in that instance, that's usually like the investment statements. But if it's something more unobservable, that may be a conversation to have with your investment advisor and see what they're using as their valuation for their report.
Awesome. And then there was another question that seems a little bit related to it, but I figure we'll ask it anyway. This question is kind of discussing GASB 72 and the level 1, 2, and 3, how to value investments. The question is actually related to the agency securities, treasuries, the Fannie Mae, Freddie Mac, those types of things. Basically, the question is, are they level 1? Are they level 2? How do we normally, what's our normal assessment on that?
I believe for like US Treasuries and for Fannie Mae and Freddie Mac, those are typically level 1, because as long as you're able to see the quoted prices in active markets for identical assets, those should be level 1. Then if it's significant, unobservable, like there are some US governmental agencies that could be level 2. It depends. But typically like US Treasuries, I would say would be level 1.
And then I guess here's another follow-up that's kind of come in as well based on that same one. In the example here, we have some level 3s up on the screen, but the question is, have you ever encountered a level 3 investment, and what was that?
Yeah, I've encountered a level 3 before, and it's typically it's where a city, or sometimes I've seen it with like pension funds, if they're like a fireman's pension fund is investing in another equity or a hedge fund, and that hedge fund is investing a large amount of capital in different securities, that's where then it can be a level 3 because it's you're investing not in the securities directly, you're investing in the hedge fund, and that hedge fund is then investing in securities. So that's an example of a level 3. Again, I think that's more, I wouldn't see that maybe on cities per se, but I have seen that like on 401k and pension plans that we've offered in.
Well, I'm not seeing any other questions in the chat or in the Q&A box, so.
Thank
Awesome.
you, Heather and Ryan. That was a great presentation. As a reminder, you will receive the recording and the slides in an email later today. Thank you, everyone, for joining us. Have a good day.